Joining me now is Harsh Kumar, Senior Research Analyst at Piper Sandler. Harsh, welcome. Now, the NBA playoffs are going on, and I appreciate a good crossover as much as the next guy. But a week and a half ago, you had a neutral rating on this and reduced the price target from 130 to 98. Now you're putting it back up at 140. What changed?
So thank you, John, for having me on your show. The biggest thing that happened is the stock's come in a lot since I downgraded. We cut the stock at about 137, 138, something like that, about a few months ago. And our thesis was that the PC sales were going to slow down. That would be a headwind to Xilinx. That would be a headwind to AMD, and also the Xilinx acquisition wouldn't be materially impactful. Well, as it turns out, AMD is navigating those headwinds extremely well, and the Xilinx acquisition has turned out to be a good one for these guys. So with the stock having come in dramatically lower since previously and trading at just 20 multiple on a forward basis, we thought it'd be a good time for investors to perhaps take a look at AMD.
Now, given what's happening in the economy overall, I mean, even throughout the whole chip sector, look at Qualcomm and how it's behaved after some strong earnings. Marvell, similarly. In a way, you were right about AMD, but it's almost like you're making yourself either wrong or you think things dramatically reverse from here in a way that the macro environment isn't saying. So what else has to happen for this call to be correct? Or do you think regardless of what happens in the macro environment, AMD's going higher?
I think it's the latter. I think the risks to a company like AMD is relatively little. The biggest risk, of course, from the macro is that the Fed is tightening. We know that, and the consumer is slowing down. And that's directly affecting two parts of the company's business. The first one being the PC business. But fortunately, or strategically for AMD, AMD made a big pivot towards commercial PCs. So the kind of PCs we have at work, other folks have at work. These are higher priced PCs that are not so susceptible to the retail slowdown at the low end. And they've been shipping these computers or chips to these computers for about 3 quarters now, and it's become a meaningful percentage of the business, and we think it will help navigate this PC market headwind that somebody like an Intel might see, for example. The second business that's susceptible to the consumer slowdown would be the semi-custom business, which is the chips for the PS5 and the Xbox 5 consoles. But as you probably know, if you have kids, those consoles are still extremely hard to find. They're still trading at way above MSRP. The chips for those are still in short supply. So we think this year, the console business will be a very good grower. So net, we have a situation where the PC business is mitigating the headwinds to a pivot towards commercial PCs. The semiconductor business, the semi-custom business is strong. The server business has always been strong for the last 3 or 4 years for the company. And Xilinx is a nice cap on the stock.
Give me your sense of what then is happening in the semiconductor space overall. We have Qualcomm turning in some strong results in its quarter, a lot of that on industrial IoT. I think their IoT business was up something like 61%. You've got Marvell also doing pretty well on hyperscalers and their cloud share. And NVIDIA's down 40%, I believe, year to date. Do you have a call on some of these generally well-performing companies overall whose stocks are down, or is this just an AMD thing?
So we upgraded the entire sector today as well. We went negative on the sector at the beginning of the year on January 3rd, and we just basically said that stocks have come in enough. Through the year, what we heard talking to investors was the recession or slowdown, whatever you want to call it, is coming. We want to see about a 15 to 20% haircut to the earnings number because that's what investors thought would happen. As it turned out, with the declines in the stocks that we've seen through the course of the year, the stocks are pretty much trading at that 15% haircut. So it's a very interesting analysis. If you apply the average multiple for the last 10 years, you get kind of stock prices that are in the range that the stocks are at today. Including a 15% haircut to earnings. Now, we do not anticipate going to the lows of the 10-year. The lows were typically set in the trade war timeframe. And the problem with thinking about the trade war is that there were about 30% of the revenues of the semiconductor industry were at stake with China that were potentially going to go away. We don't see that situation happening. We see a soft landing, perhaps even a mid landing, maybe possibly a hard landing for some time, but not a 30% reduction in revenue.